Welcome to a Wiser Retirement Podcast. Before we get started with the episode, I wanted to let you know about a new free ebook available on our website. This ebook goes over the top reasons most financial plans fail and covers what a quality financial plan should consist of. The link to download Top Reasons Most Financial Plans Fail is listed in the episode notes. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Joining me today is my co-host, Brad Lyons, and our special guest, Jordan Sute from Sute CPA. Hey, Jordan.
Hi.
Hey, Brad.
Hi, Casey.
So today we're going to focus on retiring early and the FIRE movement and all things related to that. But before we get started with our podcast agenda, let's cover a little bit about what's happening in the stock market. We've gotten off to a pretty good start, Brad. I mean, this was the year of death, destruction, plague. I mean, 2023, right? Major recession.
The year of the recession.
I mean, we're only 30 days into it at the time of this recording. So,
but interesting topic there. As goes January, goes the year.
Really? Is that a thing?
Over 70% of the time, the rest of the year follows the performance of January.
Interesting.
Yeah.
Wow.
Okay.
So it's exciting.
I learned something new,
isn't it? Yeah.
So what about the AFC NFC thing? So
no, that's not quite the.
I mean, the Super Bowl's coming up, right? So
yeah.
So if we have a 70% chance based off January, and then the NFC wins Super Bowl, I mean, that's a sealed deal, right? No.
Put all your money down, huh? You know, I don't know about the football one. I've heard of it, but I don't know exactly how it goes.
Yeah, I'm not sure who's supposed to win that. It's
Yeah.
probably the AFC. They win anyway. So
But the other one, there's lots of data on, lots of history. A little over 70% of the time, the rest of the year follows the performance
January.
of January.
Well, 70% of the time over 10 years, the market's up, right? He's a general rule also. I don't know. I don't pay attention to these rules because, quite honestly, they don't matter. They're fun to talk about.
Mm-hmm.
I just feel sorry for all the people who went to cash.
Yeah.
And they're like, oh no, this is going to be terrible. I'm going to sit this one out. I mean, this is why you got to focus long term in investing. And I mean, geez, obviously, growth stocks like tech stocks have been plummeted in 2023, but
2022.
I'm sorry, in 2022,
Yeah.
but year to date they're up 10%.
Right. So, I mean,
As
you
a
don't
group,
want to miss out on this.
As a group, there's some individual tech stocks that are up over 40% already.
Right. So we're probably seeing a rotation in tech a little bit away from the larger names, the FANG stocks.
Yeah.
And so we're seeing them more in the, I think in the manufacturing of tech, with the chip makers and some of that.
Right.
So we're seeing a little bit away from the software and the services and perhaps into the hard economy of technology. So, but nonetheless, tech was down a little over 30% last year. Now it's up over 10% so far this year.
You have to stay focused long. Well, geez, if you go back prior to 2022, I mean, you had a
Tremendous gain over the years.
Over 100% at one point.
Yeah.
So it's again.
It's something that we talked about this time last year. In fact, even though it did go down, I mean, if you went back and listened to this podcast a year ago, the topic was it's hard to see an economy being driven by something other than technology going forward over several years.
Right.
So whether it's in productivity enhancements, new development, new use of software, new use of hardware. So it's going to drive it through several different sectors, medical, utility. Technology itself tends to beget new technology.
Right.
Yeah.
Real estate, that's another one.
That's another one.
Up
Real estate
10%
had a
year-to-date.
terrible year last year, and REITs was down over 25%. Now it's up almost 10% this year.
So far. There's a lot of water to pass under the bridge for sure. I think the S&P 500 is up over 6% as well. Even the aggregate bond market's up about 3% year to date. Plus the yields are higher.
Plus the yield is higher.
Yeah. Everything's green across the board. And it would just, but that's not what people were talking about in December.
No.
So I think, what do you think it hedges on in the end?
Literally, it's going to hinge on whether or not we go into any sort of recession, and whether or not we've already discounted that to the effect that investors, are already discounting and had discounted it to what effect it happens. Now, last year, we went into a recession, but then we argued about what a recession was. So I was thinking about this.
Yeah,
the whole idea
that's
is
right.
We may go into recession, but they may change the definition of a recession, so we may not go into recession. So what is a recession now? It's kind of up in the air. So
right.
I guess investors are going to be the ones who look at this. But I had somebody share with me not too long ago, we don't invest in the economy. We invest in the stock market.
Right.
So the economy may go into recession, but that doesn't mean stocks are necessarily going to follow that off the cliff. Okay, investors are looking beyond it because if there is one, it's likely to be shallow. Just like last year's was shallow. It was like 0.1%. Unbelievably small.
I actually need to research that. You think about stocks and investing. Our grandparents, they were probably buying, cornflakes have been around forever, right? They're probably buying cornflakes, and their boxes are probably like 10 metal boxes, but there are tons of flakes in there, I bet you.
Yeah.
Right now, the boxes are like the family size is used to be like the single size, and there's more air in that bag than there are flakes. But you know what? Still making money. Still making money. So it sucks for the consumer, but for investors who have invested in these companies, there's ways to make more. There's ways to make more money. Technology allows us to manufacture cheaper, or they just take away product and charge the same price. So that's why my point is that's why I want to be in stocks.
That's right. Either way, American business managers are going to adjust to whatever the economy is and wherever the profit levels are that are required by investors in order to get that investment in their company. So, American business managers are probably better now than they've ever been. Balance sheets are certainly better than they've ever been, with interest rates having been so low for so long.
Right.
They had the opportunity to refinance old debt at higher rates and extend these low rates out for years and years. That can be used for, product and research and development, new products, new services, new marketplaces.
And you have to remember, you have to separate how you feel about politics and about the world around you.
Oh, absolutely.
From the portfolio and performance, what happens. They're actually not as correlated as you would think.
Right. And the day-to-day things that we are hearing about in society through this 24/7 news cycle that we're in.
I was on Twitter last night. You can follow me, by the way, at Wiser Investor. That's my Twitter handle, at Wiser Investor. I don't have that many followers, so I thought I would start. I'm a big SpaceX fan. Been to a couple of launches now. Yeah. My man Elon owns Twitter now, so I figured I better get on the platform. And man, it was so negative last night. Just all the stuff. It's like the White House is like the Republicans. This is from the White House. There's Republicans are going to squash, reduce Social Security and Medicare. I'm like, really? Who's proposing that? And so I go off of Twitter. I go into Google and I start researching. And there was like somebody from Florida said that maybe we should cut back some of these entitlements. Someone insignificant. So literally no one's actually said that.
Yeah.
And then I go back into Twitter and I'm like, Lee, this is no different than Facebook.
It's doom scrolling.
It's doom scrolling when you go through.
Oh, cool.
It's just worse. Everything is worse than the tweet before. Yeah.
Yeah, it's crazy. And of course, everybody was just like really getting at each other in the feed and everything. And I was like, I don't know. Very interesting. He's got some cleaning up to do, I think, on the Twitter front. But.
Well, there are some investors that say when the news is at its worst, it's the best time to buy stocks.
The financial news for sure, and I think that was last year. And now we've transitioned into people feeling a little more rosy because potentially maybe the economy doesn't hit as hard as they think it's going to. And you've taught me this, Brad. Anytime you read an article, you have to research the person who wrote the article to figure out what their bias is. And so many times, especially in the Wall Street Journal, they have very accomplished portfolio managers will write articles or opinion papers. But then when you read them, they're like dividend or value based. And of course, they're going to say doomsday because if there's not a doomsday, they don't make any money.
Right.
So they want to be somewhat of a doomsday for them, Anyway, Jordan, you want to join us in the conversation now?
Yeah. I'm taking notes, mental notes right now.
That's glad this is on video, so you couldn't go to sleep during that segment. But well, let's transition a little bit. Let's talk about 72 T's and retiring early, which sounds great to so many people. I don't see myself retiring early. I like what I do. Maybe do it a little differently. Maybe on a beach somewhere, but actually I'm not much of a beach person. Maybe in the mountains. I don't know, but
work may evolve towards that.
yeah.
Okay, it's changing very rapidly already.
Right.
And this is where, business managers today adapt to a changing environment. So as employees, we will adapt to a changing environment as well. And that includes retiring early, past the, earlier than the traditional age, earlier than what Social Security, had presumed for us. So that means money has to come from other sources, such as our retirement accounts that we build up through work. Right. But even that is based upon later retirements. And so now there are these exceptions. They've been around for a while, but they're becoming more and more popular to be able to withdraw money from our retirement plans in order to live off them.
So, Brad, have you heard the FIRE movement? Very few people have.
I have.
FIRE stands for Financial Independence Retire Early. So it's F period, I period, R period, E period. Mm-hmm. So basically, Dave Ramsey's telling us that, basically these people want to retire between 30 and 40 years old. And I mean, some people don't even know what they want to do until they're 30 or 40 years old. But in order to achieve it, you got to save 50 to 75% of your income. So I kind of see it also. I mean, maybe it's in this article somewhere, but you got to be making a lot of money to make this happen.
It was in the article. It's very significantly displayed in the article too, that you're usually talking about large sums of money,
right?
Of
Over
income.
$100,000.
Yeah, but it also presumes that you start early, both working and savings,
living at home.
Yeah,
and there's no club memberships or anything like that here. It's bare bones ramen noodles.
Yep. No going out to eat.
Yeah.
Yeah.
No, not even the nice ramen. It's like the Walmart ramen, right?
One you can buy in like a 30-pack. Yeah.
The 30-pack. Oh, not even Walmart. It's the Sam's. This is Sam's ramen. Oh, my goodness. Hey, first of all, I don't want to make fun of them. I mean, the bottom line is these people have a purpose and a mission. And so that's, that's our theme this quarter, right? Is
intentional.
Yes.
To be intentional. To
be intentional. So good for them. I mean, I think some people just kind of walk through life very lost, but people in this movement they don't want to work. They want to be able to travel and enjoy things. And so what they have to do is they have to start dreaming and planning for retirement, because if you're 24, 25 years old, you only got 10 to 15 years to be working and saving as much as you possibly can.
And if you're able to save 50 to 75% at a young age, I think that leads you to create habits that you're not going to be overspending in retirement as well. So I think the kind of people who are geared towards that are setting themselves up for a nice future.
Yeah. I just wonder, we have several young people here that are saving quite a bit, but I don't see them like living at home in their parents' basement, and they're trying to retire maybe at, 50, 45. They say 45, they end up having to push it to 50 or 55. Medical is just the biggest issue. But they do have to find ways to keep their expenses really, really low. So,
that's a big part of it.
Yes,
was the expense side of the equation. Because literally, if you can avoid an expense, okay, it's like receiving a tax-free raise in your checking account.
Yeah, right.
So if you avoid a debt that you don't have to pay, or pay off a debt that you were paying, all of a sudden you just have more free cash flow in your account. But
you have to get. To me, you need to do it debt free. So that means you've got to get the house paid off too, right? I mean, if you're going to live on a bare bones budget in retirement, I just don't see having any payment. So not only do you need to save a nest egg big enough for you to live off of, because Social Security's not available, retirement's not available, you're going to have to also build or also eliminate a mortgage. So it's hard. It's just hard to envision that in this economy right now. But people are doing it. Also, too, I wonder how many of the FIRE movement people are actually working more than one job. I've talked about this before on our podcast, but we've counseled several families that at least one spouse has at least two jobs. Working with one now that has a really cool guy came out of SpaceX, where they work them just like crazy, but he's working 2 full-time jobs and he's making 6 digits on each, more than, high 6 digits on 2 different jobs. And they don't know that he's working 2 jobs, but he just does it.
Wow. That's something that remote work allows people to do.
Right. Yeah, that's right. You wonder if it's ethical, but I guess as long as the project's getting done, then what does it matter? Because as a company, you're thinking, okay, this is what this job is worth for me, and if the project's getting completed, I don't know.
Watch out for some employment agreements soon, but otherwise, yeah, if
I know
it's getting
exactly.
Done, then
exactly. Probably in that space is like as long as he's not sharing the technology between the companies, then maybe that's all that matters. Obviously, saving and investing had to become a priority. Not getting into credit card debt. I just you just have to start early. That's what it comes down to. But if you manage to do it, and you get to the point where you now have, I think you'd have to have multiple buckets of money. So you're putting money in pre-tax into retirement probably, and then you're putting money into a brokerage account and you're saving there. I think some of them probably do it through, I see this on my CNBC feed. Some people do it trying to buy real estate and renting it out, but that's so deceptive. I get frustrated when I read the articles. It's like so-and-so bought 4 rental homes and now they have, and this is the word they have to be careful of the word they use. Now they have $100,000 a year in gross passive income. Well, they have $100,000 a year in gross passive income, but they also have mortgages on 4 investment properties, and so their net is not really $100,000. That's very deceptive when they write those articles.
Absolutely.
Yeah. I noticed all the Bitcoin ones have kind of disappeared. There's been a lot of people living on Bitcoin because they were early investors in Bitcoin, but we don't hear about them as much anymore. All right, so there are steps, and even if you're not part of the FIRE movement, even if you're just ready to get your financial life in order, our version of doing that is you eliminate all the stupid debt. So you get rid of credit cards, you get rid of even auto loans. All you have left is your mortgage. After you've gotten that eliminated, you make sure you have your emergency reserve fund set up. So that should be probably about 6 months of your expenses. After you have 6 months of expenses taken care of, then you start rolling into retirement. And you start saying, am I saving enough for my retirement? While at the same time, making sure that your home is getting paid off by the time you retire. That process, that planning process is what we take our clients through. And then after we get the allocation right in our retirement account, we're saving enough, we then can focus on college education for kids. Every family has a little different angle with that. After we check the get education box, we're going to then go into what we call the opportunity money. And that's where it's really fun to get planning, because you're saying, you're saving enough for retirement. You have your kids, the next generation, your legacy being pushed toward hopefully a debt-free education. And then the opportunity money could be early retirement. It could be tax opportunities in retirement where you're able to live off that opportunity bucket money. And so between maybe 55 or 65 or whenever you retire, between then and 75, your required minimum age, RMD age now for younger people, you can start converting IRA to Roth during that time period. So now hopefully you're only being taxed at 12%, and you have this you're living off your capital gains in the other account, which is taxed pretty small rate at that point. So there's your beginning. If you want to join the FIRE movement, those are your wiser steps to get started with that process. And so you can dream. You got to start with dreaming, I guess. But then the second part is you got to eliminate all the debt and start focusing on building wealth. Now, let's say you're there, Jordan. You call your CPA Jordan up and say, "Hi, best CPA Jordan. I'm only 50 years old, and I want to pull money out of my retirement or my IRA, but the IRS is telling me I'm going to take a 10% penalty because I am younger than 59 and a half. Mm-hmm. What in the world do we do? Because the government's not set up for this whole fire thing.
They're not. You're right. And there are a few options, and I know we're going to get into 72T, and I think it's a little misleading because you might hear 72T and you've heard about it before. You're thinking something about these payments that need to happen pretty routinely, but 72T in itself is a whole multitude of exceptions. So let's first figure out why you need this money. Is there another exception that we could fit under, whether it's medical expenses? Are you looking to buy a house? Paying for higher education? Those exceptions are also covered under 72T and will get you out of that 10% penalty. But if it's just to, hey, I want to retire, I want to travel, I want to, live on this money, then we're going to have to go to a very nuanced section of the rule, which is these substantial equal periodic payments, SEPP. And it's a very specific calculation based on either life expectancy or an amortization table, and it lines out for you exactly how you and how much you can take out of your retirement account while avoiding the 10% penalty. But there's a whole lot of rules there that come into play, and I definitely suggest meeting with somebody who knows those rules and can help you do it correctly, because the consequences if you don't do it correctly are not good.
So the 72T, you're telling me it's a formula, basically? Yeah.
Yes. So you get to pick between 3 different methods, and each one will tell you how much you can pull out. One's kind of on the lower end, one's on the higher end, and then one's right there in the middle. Mm-hmm. But whichever method you pick, you got to stick to it for at least 5 years or until you hit 59 and a half.
So
whichever is longer, the longer period is.
So if you do it and you're 57, you're going to go past 59 and a half.
That's right.
And you can't make any additional withdrawals, or you break the agreement.
Right.
Yes.
Yep. It ceases to be substantially equal.
Mm-hmm.
Then the 10% penalty then applies.
And it's retroactive too. So if you end up, messing up the calculations here, if something gets out of whack, the IRS can come in and say, wait a second, this was never, substantially equal. And they'll come back with the 10% penalty retroactively as well.
That's not fun.
It's not fun. No. So that's I would suggest it as a last resort.
You got to set it up, and then you got to make sure those are the right payments, and then no payment is skipped.
Right.
Is that an annual thing, or is it a monthly thing? Or do you have to pull out so much per year, or is it just?
It's a yearly calculation. Okay. So I'm sure it's probably dependent on your brokerage, whoever's holding it.
You would need to make sure that it's all I's are dotted, T's are crossed by the end of the year. So that 1099 shows the exact amount that's supposed to come out.
Right. And I think that's another big thing that people don't realize sometimes with the reporting, the 1099Rs.
Yeah.
They're given a copy of this 1099R and there's a code on it, and that's also reported to the IRS. So it has to be right on that tax form, because that's, we're going to input it as we see it on the form. There's no manipulating that, in taxes. So
you could use, if you had multiple IRAs, could you just do this in one IRA and not the other IRA? Or is it across the board? It all gets lumped in together? Because I don't know. Let's say you had $1 million in an IRA and say, okay, this is going to be a 72T. And then you had $50,000 in another IRA that's not a 72T. I don't think that would fly, because your 1099 is going to all add up to be the wrong number.
Right.
Or the formula, if you could do it, the formula is going to be reduced, right? So if you need X amount of dollars, you might need both accounts to add up to be that amount.
Yes.
Because I used to think substantial and equal payments just meant that, well, substantial, you just got to make them, big. But there's actually a formula.
Right. And I hope it's what you need, because
there's no changing it.
Yeah.
You get one to.
Yeah, there's no.
You can go from one method to another one time, okay, throughout the period. But you said in our example where the person is 50, as time goes by, inflation takes an effect on this. Right. So 9 years later, you're still taking the amount that you took when you were 50, even though inflation may have eaten into that purchasing power.
Or if you had
a
family emergency or medical emergency, and you had to pull out money 5 years later, all that 10% penalty applied to the
and it doesn't matter the performance of that account from an investment return standpoint. Mm-hmm. You have to keep making those payments.
Right. Yeah, that's true. What if you didn't need it anymore?
Mm-hmm. Yeah. Not good.
Yeah. I've found it's been restrictive. I typically in the past, if someone's within a year, it's almost better just to pay the 10% penalty if that's all you got, and they just insisting that they're not going to work anymore.
Right.
I just wouldn't mess with it, but it is an avenue to avoid it.
It is.
I think it probably works best if you have other funds elsewhere to fall back on,
Right.
savings, what have you.
Yeah.
Now, what I try to do if we're in this situation is don't even do a rollover. If you retire from a company, you have a 401k money, 72T doesn't have to be applied to that.
Are you talking about the Rule of 55?
Yes, Jordan. I'm talking about the
Okay,
Rule of
good.
55.
Yeah,
do you know anything about that?
I do. I like this one. I think it's a great option as opposed to 72T and the very nuanced calculations. The Rule of 55. If you leave an employer and you're at least 55 years of age and you're in their either 401k or 403b plan, and you leave that money in that plan, so you don't roll it over to an IRA. If you're at least 55 and you separate for any reason, you can take money out of that 401k plan without being subject to the 10% penalty. But the employer's plan has to let you do that. So they get to decide when setting the plan up whether or not that's an option they're going to give their employees. And then sometimes they even make it where if you want to take money out of the 401k and you're 55, you have to take a lump sum. So obviously that wouldn't be a good idea. So you'd want a flexible plan where they allow it to happen and on your timetable and the amounts that you would like.
I've never seen a plan that didn't offer that. That was a larger company. I think that's pretty standard. Small business. I don't know. I haven't really dealt with that with a small business because usually I'm dealing with the owner, and that's a little different. But that's something I have to start looking for in small business plans. I don't know if you just do a canned, like an ADP 401k. I'll have to go back and look at that. That's a good question. But for most people, they don't. They're at larger companies, so it's really not an issue.
There's one other thing that we've seen in our
something I'll add.
Okay.
Is if you are working and you want to retire at 55 and you have IRAs elsewhere that were from other old 401k plans that you rolled into an IRA, why not roll that IRA back into your new plan where you're currently working? That's perfectly legal to do that. And then the Rule of 55 would apply to that entire amount, as opposed to having IRA money kind of spread out.
Yeah.
So that would help too. If you didn't have enough, but you had in the 401k, but you had IRAs from old employers.
Yeah.
Or old 401k plans, roll them into the existing 401k plan. Right.
Because in an IRA, as long as you haven't commingled it with any other dollars, such as
correct
contributions directly to a traditional IRA,
what
your point is valid, that they can roll that in to the 401k
and do distributions.
From a total, or go from one qualified retirement plan directly to another.
Right. You were going to say something?
Yeah, we've seen something in practice this past year where we had a client who was in a 401k plan with her employer. She had company stock inside that 401k plan. And when she left, she rolled everything but the company stock into an IRA. And then she was able to take that company stock and roll it into a taxable brokerage account. You pay tax on your basis of that stock, not the appreciated value. Yep. And then you escape the 10% penalty. You've gotten money out of your retirement account, and it's now in a taxable brokerage account where you'll pay capital gains tax instead of ordinary rates one day.
Is that NUA?
Yeah.
Realized appreciation.
Mm-hmm.
Right.
Yeah. That actually makes sense in that scenario. Otherwise, wouldn't you rather just roll it and sell it and not have any capital gains?
Right, but you're going to be paying ordinary income tax on the distributions
on
one
the
day.
Distribution as opposed to capital gains.
So you could pay capital gains, especially if it's a large spread there.
Yeah, that's true.
And there's been a great deal of appreciation.
Right.
We just see less and less of that now. I think probably in the tech sector, there's going to be more potentially that, although technically their 401ks don't really, their company stock doesn't show up in 401ks. It's usually just grants and options and such. Right. The days of a company matching with their stock kind of ended with Enron.
I was thinking, thank you, Enron. They've screwed up everybody's retirement accounts.
Or helped in some cases. Who was it? I think GE employees still getting matched with GE stock. which is almost like fraudulent if you think about GE and how much debt they were carrying. AT&T, that's another one I'd be worried about too. Maybe less so after the sale, but that company carries so much debt. I can't imagine having most of my retirement in AT&T stock. That'd be really scary. Okay, so 72T. Probably avoid that if you can. Roll things into your 401k plan. Use the rule of 55. Otherwise, if you're in the FIRE movement, man, more power to you. That's awesome. I would just keep saving outside of retirement accounts for the most part, because if you're saving 75% of your income, you're probably not. You're probably maxing out 401k, and you'd be living off brokerage accounts or other passive income. You know, another thing too about FIRE movement I've noticed is it doesn't mean they're out of like the 9 to 5 grind, but they're still doing things. And you go on like Upwork. I feel like this is who these people are. You go on Upwork, and yes, for clip art to be created, or I just picture someone on a beach somewhere who's like, okay, I took my 2 hours today.
Yep.
And we wonder where all the workers are. I think they all just became self-employed. Right?
Yeah.
That's what it seems like.
We had a client come to us recently because their CPA retired to Florida, and she does every year. She cuts down her number of returns, and I'm just like, that's the life that I'm gunning for right there. So when I'm off in Florida one day, I've told you right here, I was planning on
you're
it.
Cut off 20% every year.
Yep.
That's funny. All right, Jordan, thank you for joining us today. If you want to use Jordan's service, Jordan, what's your new last name? I'm
Jordan Sute Norton now.
Jordan, okay, with a dash. Is that your middle
no
name?
hyphen, but I'm definitely keeping the Sute. It rolls off the tongue a little bit better than Jordan Norton.
Got it. Okay. I haven't thought that much through it yet.
Trust me, I have.
Well, congratulations. I hope you guys are doing great.
Yep.
And you can reach, you go to Sute-CPA, SuteCPA.com.
Yep.
And learn more about them.
Yep.
If you want to know more about 72Ts, hey, go to our YouTube page, A Wiser Retirement. We have several links also in our show notes. Changes to the 72T interest rates recently. What the rule of 72T is, and the rule of 55. If you need a recap, maybe we didn't explain it well today. That's there. 3 tips to retire early is also on our YouTube channel. We have a podcast episode 115. What could happen if you don't prepare for retirement? If you're not even close to being on fire, you're cold. You might want to go listen to that episode. And episode 103, your pre-retirement checklist. If you're right here on the edge of retirement, which I guess most of our clients are right there, people who come see us. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. All you have to do is just click the link in our episode notes, and we'll be happy to talk to you. See you next week. Thank you.
Thank you.
Thanks.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.